Hello, I am back. Mr. Matthews will be with us shortly. Are you there, Kevin? I see waiting for guests. So, my name is Patrina Dixon. I am a personal finance coach, and I will have Mr. Kevin Matthews the second joining me today. We are going to talk about how the banks failed, FDIC insurance, and things you should think about. Just waiting for my guest to come in. Um, let's see. Add guest. Let me see if I see him. Let's see. Okay, hopefully he'll be coming in shortly. So again, our topic is what happened? What happened with these banks? Again, Kevin breaks it down amazingly well. I can't wait for him to get on. And we're going to talk about FDIC insurance and just sharing why it's important for you to under. The reason why I wanted to do this episode is one, I want to bring forth more people on my platform that you know what they're doing and that they are, the goats in their field. And this young man, I met him several years ago. He used to have a radio show in New York, and we've just been in a lot of the same financial circles for some time. And this topic, I knew like he was the one that I want to get on. I heard him on his own show channel talk about it in such a layperson's way that I thought it would be very pertinent for those of you that follow me to get the information directly from him. So hopefully uh, he will get in soon. There are other people that are joining in. We want to make sure that our guest gets in. So just give us a few more moments. Technology, man, when it works, and when it doesn't. So let's kind of see. Just gonna see if he's there. Let's see where he is. Hold on one second. Is coming in shortly. And I thank you for your patience while you wait till we get him in. Again, I got to tell you, this young man is going to tell you in a very short period of time what this all means. And thank you. I'm glad you made it back. What is that? Brownie. Oh, the name went away. But thank you for making it back. I saw your name there that you made it back. Thank you for that. And thank you all for your patience as we get through this technology here. But he's coming in. He did give me a notice that he's coming in. So Kevin again will come in and we're gonna break down what transpired. We'll tell you about some financial topics that you need to be aware of, or terminologies. And then we're also going to talk a little bit about FDIC insurance. And again, if you aren't subscribed to the It's My Money with Patrina YouTube page, make sure that you do that. Wherever you see the subscribe button, make sure you do that. Oftentimes, I bring forth real quick hit information to help you with your personal finance, personal finances. And if you are a small business owner, I bring forth information about how you can get money for your business via grants. Oftentimes, when I have podcast guests on my show, I also bring forth that on my YouTube page as well. So, jam packed with a lot of information to help you along your financial and entrepreneurship journey. All right, let's see where he is. Hold on. I'm try to send him another. He's coming in shortly, coming in shortly. All right, technology, man. While you're waiting, and I see you all still here hanging in with me, thank you so much. Share it with others. Let people know that we're on. We're about to go. Well, I am live, but Mr. Matthews will be on with me shortly. Oh, there he is. I think he's coming now. Oh, there you go. Oh my goodness. Woo,
It
technology, man. I
it
tell you,
has been a journey.
it's been a look at your sweatshirt. You better represent. That's what I'm talking about. I love it. So I appreciate those of you that are still rocking here with me. Thank you so much for being patient. We have our special guest with us now. I am so excited. Let me just restate who I am. My name is Patrina Dixon. I'm a personal finance expert. I help people with what I call their financial fundamentals. I ensure that you have a solid foundation within finances, like saving, budgeting, knowing where to save your money, how to earn best interest rates, and how to use credit responsibly, and how to earn money on the side with side hustles, especially when you can earn it passively. And with me for today's topic that so many want to know so much about, which is how did the banks fail, and what is FDIC insurance, and how can I insure money if I have more than what the insurance covers. I have expert, my one of my financial pals here, colleagues, Mr. Kevin L. Matthews II. What's up, Kevin?
Nothing much. Thank you for having me. I appreciate it.
Absolutely. Like, I told you and said before, the way I heard you break down what happened, I'm like, I gotta ask him if he can come on and share how he talks about it with the It's My Money community, because it was very easy to understand what you heard. And if you're not in this space like we are, people are like all over the place with it. So I'll just kick it off with the question: what the heck happened with these banks? Like, what happened with Silicon Valley Bank in California and Signature Bank in New York?
hmm Yeah, so at the end of the day, we had what is called a classic bank run. And to figure out what a bank run is, it's basically to figure out what do banks do with your money. So when you go open a savings account, checking account, a bank says, "Hey, look, you put in 100. Let me take like $20 and let me go loan it and give it as a mortgage or a credit card or a car loan or a business loan," right? Which means that you don't have $100 actually, right? So if you come in and say, "Hey, look, I need my $100 today," and bank says, "I really have 80 because I loaned it out to somebody else." When you get thousands of people going to the bank, rushing to the bank, and asking for their money up front right now, you get what's called a bank run because the bank does not have that money on hand, and it's basically whoever's last is the person that does not get their money. So you got enough people rushing the bank, asking for their money, and then that's how you run into a bank run and a bank failure.
So, Kevin, before I even have you continue there, I'd be remiss if I didn't say, tell the people who you are. Like, how could I not have said that at the top? Who is this wonderful guest that I have on right now? Who are you? Please give them the credentials to let them know you are the man to be talking about what we're talking about today.
Yeah. So my name is Kevin Matthews the second. I'm obviously a Laker fan. We did not win last night. But aside from that, I am a best-selling author and three-time Plutus Award winner. I have a degree in economics from Hampton University and a master's from UT Austin. And my job is to make investing simple. I started my company, Building Bread, which is a company to help make investing simple and teach people the basics of investing way back in 2010. So I have an international audience at this point, and I travel the world both digitally and physically to teach people how investing works and how to make sure that it makes sense for you and what your financial goals are.
I love it. I love it. Thank you so much for being here. So now you know why I have him on here. So now you talked about people all going to get the money that they have in the bank, and the bank has let you put money in. Now I went to go borrow some, and they gave me some of yours, and now you want your money back. And when people rush and do that, that's called a bank run, right?
Mm-hmm.
And tell us how, I guess collectively, when everybody goes to do that, how that then cripples the bank. Like you described, you put in 100, they gave me 80 of it, so they only have 20 of your 100 back, but you want your 100. What
Mm-hmm.
do they typically? when they don't fail? How do they try to fill the gaps before it comes to a situation like this?
Yeah, primarily when how this works, and we've been doing this for hundreds of years now, right? Like, how why don't we have more bank failures? Essentially, the premise is there are two things. One, banks are required by the federal government to have enough in what they call reserves, so they're never able to loan out 100% of your money because you ask for $1 and the bank is going to fail, right? But what the bank does is they use what's called the law of large numbers, to try to have enough people, because if you have $100,000 in the bank, $200,000 in the bank, you're unlikely to ask for all of that money all at once. And that's essentially how the game works. They have those reserves to make sure that they can tolerate some volatility in terms of people coming and asking for their money, but they're really betting on the fact that most people are not going to ask for all the money at once. Very similar to the insurance industry, right? Everybody's paying their premiums, but not everybody gets into an accident every single day. So it's kind of how they manage everything.
Okay, people watching may know this as well. The government came and bailed these banks out. So they had all these people coming in there asking for their money. We know you gave an example of Roku that had a whole bunch of money in there. But
Whew,
the
they did.
government said, and we're going to get into FDIC insurance and what that dollar amount is, but why did the government do what they did for these banks? Why do you think that?
Yeah, that's a great question. It's my belief that they did so to stop what's called contagion. What we don't want to happen is for one bank to fail that causes another company to fail, and it really spreads beyond just one or two banks. That's not what we need to happen. That's somewhat what happened in 2008, where it started with one or two companies, and then next thing we knew, it everything kind of fell apart. So what the Fed came in and said, well, hey, look, let me make sure everybody is made whole so that we don't run into a bigger situation. One example, like you brought up with Roku, you're only insured up to $250,000. Okay, that's 250,000. That's it, $250,000. Roku had 487 billion. I'm sorry, $1 million. $487 million at the bank, which is far more zeros and a lot of money that is uninsured, which is an issue. So when you think about it, that was 1/4 of all of the cash that they had. So
Yeah.
imagine taking your finances right now and divided by four, and you just get one piece left over. So if that were to happen, then or that did happen, if they weren't able to get that money back, that's people that are likely to lose their jobs. Roku's not going to be able to pay the bills. Employees are not going to be able to pay the bills, and that's going to spill over into mortgages, car loans, and everything starts to get a whole lot worse, which is what the Fed wanted to avoid.
Yeah. And so somebody asked the question, if you're still there, that if you heard what he said, money in the US in banks that are FDIC insured is up to $250,000 because that was a question. Okay. So now, as you mentioned, there are several depositors at these banks that had more than $250,000 in here, and the government came and made them whole, right? So,
Hmm.
what does that mean? Does that mean every depositor got all of their money back, or just the bank got all the money back in case those people want their money? What does that all mean? Made them whole?
Yeah, so it means that if you had the account at Silicon Valley Bank and let's say, bank fails, so you can't walk to a physical branch, right? That essentially means that the federal government took over the bank and now they are issuing those funds. So if you had $5, they're gonna make sure that if you want your $5 today, you can have it. Or if you want to leave it alone, which I don't know who would do that, but if you want to leave it alone, then the money is going to be there. So if you did not have money that was insured, the Fed made sure that you had that cash available to you.
Okay, and when people, I heard you talk about those that had their money insured, they got their money back by Monday. Did the uninsured people get their money in that same time frame, or are they still working to give them the uninsured funds as well?
Everybody got their money by Monday.
Okay, so now you all want to make sure that you hear that important point. So if you are a person that has under $250,000 in a banking institution that is FDIC insured, you get your money back very expeditiously, right? And then in
Correct.
this, those that had their money, the monies that were uninsured, that the government did go ahead and honor, if you will, or make them whole, they also got their money back, or have the option to get it back expeditiously. So that's really important to understand. So now
Mhm.
about this FDIC. Like, what is this? And $250,000. You gave a little bit of history of how we got there. Can you just expand on that a little bit?
Yeah, so the FDIC is the Federal Deposit Insurance Corporation. It was created in 1933 by the federal government. This was a response to all the bank runs we had during the Great Depression in the 1920s and the early 1930s. And the limit has moved up over time. Back in 2008, it went from 100,000 to 250,000. And essentially, they guarantee that if the bank is a part of the FDIC insurance group, almost every bank is. I honestly have not found one yet that is not FDIC insured. But you'll see a sticker. You'll see it on your app. You'll see it at the bank. If you go by a branch, it's usually right down the corner on every single banker's desk to let you know if that is the case. The way the insurance works, if you have 250,000 and below, you are guaranteed by the federal government to receive those funds should the bank fail. The rules of it is very simple. You got money at the bank, less than 250, you get your money back. So that's pretty much how it works, and there are ways to increase that insurance as well.
Yeah, and I love that because I'm sure you heard this too, and you and I together heard this. Should I go and take all of my money out? We're like, no, 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 no. And especially if you have less than 250, because you're guaranteed to get that money back. Now we know, the Greek freak, Giannis at the Milwaukee Bucks. He had 50 plus accounts even before this happened. So people are now saying, should they do that? So talk a little bit about that. Like, what are your options if you do have more than $250,000, or soon will, based on what you have going on in your finances?
Yeah, so there are three primary easy options. Number one is just spread your money across different banks. Now, I don't think it is wise to have 50 banks, but again, Giannis got more money than all of us here today, and he has a team of lawyers and all types of stuff to keep all that stuff in track. The
I,
reason why
oh, I'm sorry to me cut you off. I think I read he has 56 to be exact, almost 60.
There you go. Every new contract he signs, he gets another one. But the reason why I don't think that is wise for the average person is just because should you leave stuff behind, that's a lot of different passwords, a lot of different banks, a lot of different paperwork for people to go out and find wherever your money is. Also, that's millions upon millions of dollars at that point in time. If you got that many banks. So that's number one, but you can do that. Having two or three banks, very easy to manage, and you're going to get 250 for every single bank that you have. So that's one easy way. Number two, you can have what is called a beneficiary, also known as a payable or transferable on death. You get extra protection for every single person that you add on the account. It's a very easy legacy planning tool as well, so that my bank account doesn't go through probate. So, for example, if I have myself, my wife, and let's say four kids or three kids. So that's five people total, right? Me, wife, three kids. Five people, that's $1.25 million in FDIC protection at one bank. Now I can do that at three or four more banks and continue to increase it, having those beneficiaries. And then the last option is to have joint ownership on a bank account. So I can have myself, my wife, we get $500,000 that way. Each has pros and cons. If you got a joint account, that person has access to it. They can deposit, withdraw, do whatever they want. So make sure you have someone who's trusted. And then in the beneficiary option, they don't have control, but obviously everything will pass to them and increase your insurance in the event that something happens.
So let me ask you a question on the third option. So, he just broke down three different ways that you can insure your money if you have more than $250,000. Now, on that last one that you mentioned, if you have money at Bank X, right? You have an account, and then you and your spouse have another account. Is that what am I going to do that quick math? What is that? Is that $750,000? Meaning that one account that you have by yourself, you have 250,000, and then that separate where there are two of you on, it's 250 for each, or is it
No,
because it's the same bank? That's not the case. It's just
no,
the
that
two.
would be correct. It's
It
it's
would
all
be.
about the account. Yeah, it's all about the account titling. So I could have, one that's just me, and then a joint with the both of us together. That would be 750,000 total.
Okay, okay, that's what's up. So in that situation, that's another type of account, so you can have it at that same bank, which is good. And then Kevin just shared with you adding your beneficiaries on. That's another way. And I loved how you entitled it legacy planning, because a lot of people are trying to build wealth and they're doing legacy planning. That's a great way if this is the some types of money you have liquid like that you can do it in that way. So that's
Hmm.
I said that. So now, the other thing that I wanted to quickly talk about, we got this question before as well, is FDIC insurance is for banking institutions. A lot of people have money in credit unions as well. Do they have the same? So I know that they have their own insurance, so the National Credit Union Administration or NCUA, right? But do they also have the various different options like you just mentioned with FDIC? Do you know that?
Yes, they have very similar title options as well. So
Oh,
the the technical definition is different. Like you said, it's a different acronym.
yeah.
But protections are the exact same. You can tell them the exact same way and get those same protections.
Okay, great, 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 great. Now, a lot of people, even those that have less than $250,000 or less than the 400 and something million that Roku had, they're like, what should I do? Oh my gosh, should I go take my money out? So I know you're saying yes, but they're still saying, but I'm uncomfortable. How do we ease the thoughts and the anxiety that some people are having right now because they just don't know what's going to happen next? Like, is it going to be another bank? And what's your thought on the last part? Will there be more banks that are doing this? And then what should people do?
Yeah, so it's really difficult to say. I mean, we just heard about First Republic Bank 2 days ago that they did not fail, but they did get a loan of like $30 billion or whatever it was. So a lot of banks are taking extra precautions now. So it's really difficult to say when and if there'll be another one. If there is, though, it is very likely to be a smaller regional bank. So not like your J.P. Morgans, your Bank of Americas. That's very, very unlikely to happen, but if it's a smaller bank, that's probably where I would put my money to bet that that would occur.
Okay.
If the to relax your fears for those that have it, number one, it's okay to have that fear. It is natural to have that fear based on what is going on. The key thing is this: remember, they got their money in 2 days.
Mhm.
Okay, and now we've done this before, it is likely that the next time, should it happen, you're probably gonna get your money a lot faster. The other thing too is when you are afraid and you rush the bank, you are causing the issue. That is one thing that you absolutely want to avoid doing because it's exactly what happened in Silicon Valley Bank. If people didn't go and ask their money immediately all at the same time, we would not be talking about this issue. So you want to make sure to remain calm and say, look, I'm gonna get my money anyway if it fails, but also if I don't rush the bank, then there's no bank run, and you're going to be okay. It's
I was
basically like,
gonna
yeah,
go
I
there.
mean,
You're gonna run to the bank and get your money
yeah,
there.
if you don't run to the bank, it won't be one.
I
It's
love that.
very similar to if you're like in the park and you see a bunch of people run by, what do? You get up and run because you're like, oh,
Yeah.
something bad is happening. But if you don't run, then everything is fine. So you got to be very
Yes.
careful about that.
Yes, I love that. I love that so much. So, okay, so people are, I love how you just mentioned how they can relieve some anxiety, right? And another thing that I like that you talk about is um people has to start to manage their money and build wealth, and people when they think about this, it should help them begin to think about how do I do my money now, like, I don't know if this is going to happen again. I may have $250,000 now, or I may not. Do I do what Giannis has done? And I think it's a little bit of it all except for the bank run, right? So yes,
Hmm.
have more than one bank. Yes, have potentially more than one account at a bank if there's a spouse, a husband, or two people that are in a relationship, whatever type of relationship that is. I think it's a little bit of all, right? You want, just like we need to diversify our money, having it grow in different ways, we should also have it stored in different places. I think. What's your thought on that?
Yeah, yeah, I totally agree. For me, I've got 5 accounts, and I've almost always had 5 accounts, just because one, it's just easier to have different things in different places. So I got an account just for travel, I got an account just for bills, one just for saving, and all at different banks, so I can tell the difference between the debit cards for one.
Yeah,
So that's one way. And then for having beneficiaries, it's just a basic legacy thing that I could do for free that I should be doing anyway, right?
yeah,
So if I ever have $2 million in the account, I'm gonna still be protected. But on the way there, right, I still want to make sure that I have those options available. So for me, I think you should always have more than one bank, and not just for bank failures, but what if your password gets locked? What if your identity is stolen from one bank and somebody gets one password? At least I can still have some money somewhere else, right? As opposed to everything being locked up in one particular place.
Yeah, absolutely. And I'm getting this question. I got this after you and I talked before. I got this even preparing for today. Is why did they do it for this bank? Like, why did the government come and swoop up and take care of these particular banks and these particular depositors? What's your thought on that?
Yeah, it's a great question. One of the reasons, and this reported in the New York Times and other publications too, well, they feel that they really took care of this particular bank is because of who they serve. So it is Silicon Valley Bank, which is where a lot of tech companies got their start, where a lot of tech companies, Roku included, has a lot of their money. If you were somebody looking to start like the next Instagram, it's usually Silicon Valley Bank that's going to give you that first investment. That means though that should that bank fail and those people don't get their money back, number one, that's going to cause a lot of harm to people who are above the insurance amount. But if a Roku goes, loses 25% of their money, if Etsy had their money there as well, if they lose 25% or more of their money, that's a lot of jobs connected to that one regional bank. Whereas I'm making up a bank here, Bank of Omaha or something, may not have that many large companies, and the threat of contagion may not be that big.
Got it. So again, I've heard you use the word contagion a couple times. Explain to them what that means, because what the way you just described that is beautiful, right? The impact of that bank failing versus another bank, one you just gave an example of, that has a huge trickle down effect. The one that in Silicon Valley versus the other, and then what you call a contagion, that then what's the word, downstreams to the rest of various different things that run within our country. So is that the definition of contagion?
Yeah, that's essentially the definition. One way to put it, since we're talking about basketball earlier, there's a difference, right? If a Giannis or even a Kevin Durant, right, if they get hurt, that changes everything, right? Somebody else can win the championship. You got a lot of stuff going on if a star player gets hurt. The star player in this case was SBV. They're a star player in Silicon Valley. If a somebody who's on the bench that you don't really see, they get hurt, yeah, it's bad, right? But they probably gonna win anyway, right? So
Yeah.
that's kind of how it is between some of the more what we consider more important banks because of who they serve and like how important they are too. The other thing too is if Silicon Valley completely went bankrupt and failed beyond the insurance, there are other companies that are looking for funding that would not have it, right? Not being able to make payroll and everything else in that particular region of the country.
Okay, got it, got it, got it. So, it's a lot. Like, this is again, I feel like it's still every time I turn on the news, people are still talking about it. And I don't know if anything unraveled today because I wasn't watching the news today. So is there anything that's of recent that I didn't already ask about that we want to make sure those that are tuning in know of, the most up-to-date thing relative to this topic?
Yeah, so there are some other regional banks. First Republic was one. You had an international bank, Swiss Bank, have been asking for their central banks. So like our central bank is called the Federal Reserve. Have been asking for funds just to make sure they have the extra protection. So banks are proactively looking to shore up their funds in case something happens. I think CNBC just reported that banks have asked for, I think it's more than $150 billion in loans from the Fed just to be protected. So they're definitely being proactive to avoid anything. We'll see if anything happens, but that's the latest development that I know of.
Okay, and based on your, thank you for that. I
Mhm.
appreciate. And based on your understanding of and just watching, because I know you watch a lot of this stuff, interest rates, right? So interest rates, especially for high yield savings accounts, started to rise. Do you
Mhm.
think there's some impact in decline because now people, I'm just, which way do you think it's going to go? Because some people are taking money out, some people are heeding to what you're saying and like, don't go and run and get your money, because I've seen the interest rates go up and down, and right now they're actually kind of quite favorable, especially at online only savings accounts. What do you think is going to happen there? Because it's a volatile right now. What do you think regarding interest rates?
Yeah, interest rates are going to continue to rise. We'll find out next week. The expectation is that the Federal Reserve is going to raise interest rates by 0.25% next week.
Okay.
The reason that is we still have really high inflation at 6%. And the Fed says until we get inflation down to like 2 or 3%, we got to keep raising rates. So your savings account rate is going to continue to rise, but it is going to make things a lot tougher on companies that are not currently profitable because if you're not making money, you have to borrow money. You have to borrow money, you got to pay a higher interest rate. So it's going to make things a lot harder. But that's another reason why some of these banks have failed too. So
Mm,
that's kind of like the level two explanation of like what's going on is that another thing that banks do outside of loaning it for mortgages is they invest in government bonds, right? They
mm,
invest in things that are super, super safe. Well, the problem is if you invested in something that was paying 1% a year ago, and new things are coming out paying 4 or 5%, the value of what you invested in plummets. And
yeah.
that's the issue. So because people were coming to ask for the money, they had to sell those investments that were down and that they had the money, right? Because those investments lost value because they didn't get a chance to hold it for long enough. So that's another thing. So it could get a lot tougher as these banks continue to as the Federal Reserve rather continues to raise rates. So we'll definitely see.
Yeah, that's interesting because a lot of what I'm doing with folks that I serve is high yield savings, high yield savings. Like the numbers are going up and up and up, and I actually just got this question yesterday. So they're they can go up and down, and I always tell them online only savings accounts, which are my favorite. Right? They go up.
Hmm.
But they're all. I think I'm right in saying. I know I'm right in saying this. I don't know how long that's been though, but as long as I've been doing what I do and following that, they're always be higher than brick and mortar savings accounts. Like that's what
They
I,
have been. Yep.
yeah, yeah.
Yep.
So they have, so it's always a better place. And even when it goes down, it's still going to be a little bit higher than the next and more than what you would earn not having it in your mattress. Right.
Yeah, yeah. I mean, a lot of these online banks, like depending on which one you go to, pay like 30 times more
Yeah.
than the largest bank out there. So,
Say
I
it again,
mean, it's
my friend. Say it
yeah,
again.
yeah. We're talking like a 30%, 30 times difference. So
Yeah.
if I go to look at largest bank in the U.S. and what you pay on your savings, and go to any one of these online banks, they're almost always going to pay you a lot more there.
Yeah, and I tell people if your money, so savings accounts are not supposed to be your operating accounts. Put your paycheck in or whatever, and writing for your bills, etc. If you have money sitting for vacation, retirement, school, college, whatever it is, why not earn money on the money that's just sitting there? So the longer you keep it in, to the point we talked about, when there's not a bank run where people are going to request it all out, you got yours in there. As long as you can get back what you had, once you earn that interest, it doesn't go away. It may like,
Right.
or like what you got in there, the a potential for earning may change, but what you've already earned is yours, right? And as long
Yeah.
under the amounts we've talked about, and you use the various different, now that they have the knowledge of the various ways that they can protect it, insure it, if you will, then do that and continue to earn when you can earn, especially when it's high right now.
Right. Absolutely.
Yeah. So I'm just checking in. Let me see if I have any questions. Like I could talk to you forever. I haven't even been watching to see if there's questions. Let me see if there, I think this is the button to see if there's questions. If you have questions for, oh, what do I have here? It says, what is the insured limit in the US? I think I answered that. So the insured limit in the US, the FDIC insured amount is $250,000 in the US. And then Kevin just shared with you different ways that you can get more protection on your money if you happen to have more than that. Let's see, what was the other one? I think there was another question. Oh, they said I might get tossed out for this, but I'm going for the Celtics.
I saw that.
Oh, you saw it? All right. So if you have any questions, please drop your questions. We won't hold Mr. Matthews if we don't need to, but if you have a question, please drop your question. This will be on the YouTube page, so you can go back and take a look at it if he wasn't here the entire time. Let me just do one more look. All right, Kevin, while we're waiting to see if we're going to get any more questions or if other folks come in, why don't you go ahead and tell them where they can find you if they're interested in, and which I'm sure they are, of connecting with you more. Let me just try to get this off the screen. Hold on.
Mhm.
I don't.
While you do that, you can find me at all things social media at Building Bread or at buildingbread.com. You can find me here on YouTube at Building Bread, where I drop brand new videos every single day, Monday through Friday.
All right, great. And Bill, how did you come up with the name Building Bread? I remember you telling me the story. How did you come up with Building Bread?
Yeah, so I don't know, what was I, 19, maybe 20 when I did it. But essentially, bread is another metaphor for money. And my thing was I wanted to build it, I wanted to create it and create, just like you would build a building, right? You create plans, you have a process, and you make sure that you see that process through. So that's the kind of stuff behind the name.
Wow, nice and simple. I love that there. And I'm loving the purple background. I saw the comment about that somewhere as well. So loving that as well.
Thank you.
All right, so let me just make sure I got all the questions that I have prepared for today's session all taken care of. You did answer. Did you answer how similar or different from 2008?
We touched on it briefly. Essentially, in 2008, well, this time it's a bank run. That's the main way. The other side was contagion was one reason, but the biggest reason is that people weren't able to pay those loans. So they sold some pretty terrible mortgages back in the day, 2007, 2008. People weren't able to pay those mortgages. When those mortgages were not paid, they when I say large scale contagion, it was real bad. So the simple version is these mortgage loans were put together and sold as investments itself. So you got the mortgage loan that people couldn't pay, and then you had investments based on those mortgage loans. People who invested in those mortgage loans included pensions, cities, states, and individuals. And once those things started to fall apart, people couldn't pay, banks go under, then those investments go under, and people couldn't get their retirement money either. So that is kind of how things kind of really exploded. The Big Short is a famous movie on it that breaks down everything there. But for example, we talk about contagion. It wasn't just Washington Mutual Bank; it was the city of Detroit that went bankrupt. Right? It
Mhm.
was Ford, GM, like they all went through it, all based on this investment that went pretty badly and was contaminated and went throughout the entire economy at that time.
Okay. All right. So very different. And
Yeah.
different than what we're experiencing right now.
Very
And
different.
hence why you described earlier the government doing what they're doing so that it kind of stopped the bleed, stop the contagion, I guess, if you will, by doing.
Exactly.
Yeah.
Yep.
Exactly. And hopefully, you all, as you hear this, that will, again, relieve some of your anxiety because I know there's some question about why they did what they did for this particular bank. Kevin has done a great job explaining why, but then that also should give some level of, I'll call it comfort, because that happened. There isn't the trickle down effect. So what would be scarier if they didn't, and then people are scurrying around and people not being able to be paid, then they can't pay their mortgages and their car payments, and then it'll be all these other things. So
hmm
that actually was um a good thing that that happened overall. So, and
Yep.
go back and listen to the reasons that he described earlier. So Mr. Matthews shared with you what happened, what a bank run was, also FDIC insurance, and why that's important, and then three different ways that you can cover your money that's over 250,000, and one that's considered a way to do your legacy planning as well.
Yep.
And credit unions, their insurance, which is the same and at the same dollar value, $250,000, is called NCUA. So if that's where you have money and have the eligibility to be in more than one credit union, you want to make sure that they have that, and that's called National Credit Union Administration, or NCUA. And I think that's about it. So, Kevin, again, I'm going to put your website down below. He has great things on his YouTube channel as well, so that you can go in and take a look at the pieces of information that he shares to help you better understand things that are going on in the financial and investment world. And how many did you say you do a year?
250. 250
200,
videos a year.
202. Did you hear that? I'm trying to keep up and do two. No, he does 250 a year. Oh my God. What's the frequency for which you publish?
Monday through Friday.
Oh, Monday through, oh, okay. How, what am I? Oh, because it's not the weekend. So I'm like, wait a minute.
Yeah, yeah, not the weekends.
So Monday through Friday, he does 250, y'all. 250. That is a huge undertaking to come forth every day, Monday through Friday, to bring forth information. So make sure you go and check him out because the whole saying, when you know better you do better. So when he's coming to help you know better, you want to make sure that you go and get that knowledge that's put out there for free, right? YouTube is
Yep.
free to check out. So Kevin, thank you for what you do. Thank you for 250 packed powerful information to help people be better about finances and investing. I appreciate you for doing that, and I appreciate you having conversations with me for my community of the It's My Money Squad. Thank you for that.
Yes, thank you.
You're welcome. Make it a good day.
All right, you too.
All right. Bye.